It all started before the pandemic, and few people realized imagine a house full of cracks, but no one cares until the roof starts to cave in on your head. That's how the American economy was in 2019, before COVID even became news. Banks started to distrust each other and stopped lending money quickly, the kind of loans that happen in a single day in the so-called repo market. Think of it as the economy's pipes getting clogged, leaking money and problems without anyone wanting to admit it. Then in 2020, the pandemic hit and governments threw a ton of money at the economy, trying to fix the leaks. But it was like putting colored tape on the cracks. It seemed like everything was fine, but it only delayed the real problem. Today, inflation has skyrocketed. Even very large banks are threatening to collapse, and the financial market is like a crazy roller coaster. This is all a consequence of that poorly done patch. And those who are better prepared are looking at dividends, a safer way to make money with companies that pay part of their profits to shareholders, even in uncertain times. If you don't take action now to understand this scenario, you could end up missing out on the chance to protect your money, or worse, see it melt away in the crises that are yet to come. It's time to open your eyes, get informed, and use strategies that put you in control, not on the tightrope. So to understand the context, inflation applies. What is it, inflation, and why does it take away our purchasing power? Imagine you give your daughter $5 to buy an ice cream. Today, with those $5, she can get a medium-sized tub with topping and even a cherry. Cool, right? Now imagine that a year from now, the same ice cream costs $7. With the same $5, she can only get a simple cone, and that's it. That's inflation. Your money remains the same, but it buys fewer things than before. But why does this happen? Let's go back a bit. When the government or central bank prints a lot of money or throws a lot of money into the economy, as they did during the pandemic, it's like putting more chips in a game where no one has increased the amount of prizes. More people have chips in their hands, but the same prizes on the table. The result? The prizes get more expensive. In the real world, it's milk, bread, rent, gas, everything going up. And the worst part? Our salaries usually, now they go up at the same rate. So, every month, it seems like our money shrinks a little bit more. Buying meat becomes a luxury. Going to the supermarket becomes a challenge. It's like running on a treadmill that gets faster and faster, but you're wearing flip-flops and holding heavy bags. It's tiring, right? And here comes the most worrying part. If inflation continues for a long time, people lose confidence in the value of money. And when that happens, it's as if the whole game has to be restarted, and almost always painfully. Then we have the interest rate, and how it affects your life in the US. Interest rate is basically the price of borrowed money. When you borrow money from a bank, whether it's a credit card, a car loan, or a mortgage, you pay extra for it. That extra is the interest rate. In the United States, the base interest rate is decided by the Federal Reserve, Fed, which is like the country's central bank. When the Fed raises the interest rate, it becomes more expensive to borrow money. When it reduces, it gets cheaper. And how does this affect your life? Credit cards. Higher interest rates mean debts that grow very quickly. If you leave a balance on your card, you will pay a lot more for it. Home or car financing. If the rates are high, you will pay more installments and higher interest. Conservative investments. On the other hand, when interest rates rise, investments such as savings accounts, CDBs and government bonds also yield more. In other words, it may be a good time to save money with a higher return and less risk. Inflation and consumption. When the Fed raises interest rates, the intention is to curb inflation, because with more expensive credit, people and companies spend less, which helps to keep prices from rising. In short, high interest force you to spend less and save more. Low interest facilitate consumption and debt. Knowing this helps you make better decisions with your money here in the US. Another important subject is how financing works, car, home, etc., in the United States. Now that you understand How interest works and affects your life. Let's talk about something very common around here, the financing. In the United States, it is super common to finance large purchases, such as cars and houses, because unlike Brazil, access to credit here is usually easier, as long as your credit is up to date, of course. But how does it work in practice? Car financing, auto loan. When you want to buy a car but don't have the full amount up front, you take out a loan. The bank or finance company pays for the car for you, and you turn this money in monthly installments with interest. Some important points. Deadlines vary greatly, from 24 to 72 months, sometimes more. The interest rate will depend on your credit score, the down payment you make, and even the car model. Many dealerships offer promotions with low or zero interest, but it's a good idea to read everything carefully. Sometimes the final price of the car is higher in these cases. Home financing, mortgage. Now, financing a house, called mortgage, is an even bigger decision. Here are the basic points. Most Americans do this type of financing to 30 years. The interest rate can be fixed or variable. Fixed is more predictable. Variable can be risky depending on the economic scenario. You need entrada, down payment, usually between 3% and 20% of the property value. The higher the down payment, the better the loan conditions. In addition to the monthly installments, you still have to consider insurance, taxes, and maintenance, the link with interest. Remember the interest rates we talked about earlier? So, when the Fed raises the base rate, interest rates on loans go up too. This means that the value of the installments of whom want to buy now gets louder. Anyone who already has a fixed interest financing is not affected immediately. It may be worth waiting for a time when interest rates are lower, or negotiating our financing if interest rates fall in the future. Understanding how financing works is essential to avoid falling into traps, especially if you are starting your life here in the US or thinking about changing cars or buying your first home. Now that you understand how financing works, you need to know something essential to get good conditions on any type of credit: your credit score. In the United States, practically it's all about your credit. It's like our port card of your finances. If your score is high, you can get lower interest rates, easier approvals, and even rentals or jobs, with less bureaucracy. But how do you build this thing, good credit? What is a credit score? Your credit score is a score that goes from 300 to 850 and shows how reliable you are in paying what you owe. This score is based on a few key factors. Payment history, 35%. Pay your bills up to date is the most important. Delays will quickly drop your score. Credit usage, 30%. This is how much of your limit you are using. Ideally, you want to stay below 30% of the total available. If you have a $1,000 limit, try not to use more than $300. History time, 15%. The longer you have active credit, the better. Therefore, don't close your old cards for nothing. Types of credit, 10%. Having different types of credit card, financing, student loan, helps. It shows that you know how to deal with different forms of debt. Recent queries, 10%. If you apply for credit too many times in a short period of time, your score may drop. This shows that you may be desperate for credit. How to get started if you are new to the country. If you've just arrived in the US, it may seem complicated because you don't have a history yet. But here are some tips for starting from scratch. Open a secured credit card. You put up an amount as collateral, e.g. $200, and that becomes your limit. It's a safe way to build credit. Pay everything on time. Paying the full amount is even better. Keep card usage low, as we mentioned. If possible, ask to be authorized user on a card from someone with a good track record. You inherit some of the credibility. How to maintain good credit. Once you've built it, maintaining it is the challenge, and that involves organization and discipline. Use alerts or automatic debits to avoid forgetting due dates. Increase your limit over time, but do not increase your usage proportionally. Check your credit report every year. You are entitled to one free check per year per agency in annualcreditreport.com and correct errors, if any. Now that you know how to build good credit, it's time to talk about something that can ruin everything: fraud and financial scams. Unfortunately, the United States has a lot of digital resources, which is great, but that also means that scammers are always creating new ways to trick people. And immigrants, especially those who are still learning how the system works, are an easy target. Why do you need to protect yourself? Imagine that you have done everything right. Your credit is up to date, you pay your bills, you save some money, and suddenly someone uses your data and takes out debts in your name, or withdraws your money from the bank, or makes purchases with your card. This happens more often than you think. Therefore, protecting your data and your accounts is as important as saving money. Main types of scams in the USA: phishing, email, SMS, or phone scams. Scammers pretend to be banks, companies, or even the government to ask for your data, passwords, or card numbers. Example: you receive an email saying that your card has been blocked and you need to confirm your details. Golden rule: no company or bank calls asking for your password or full card number. Immigration or IRS income tax scams. You may receive calls or messages saying that you need to pay an urgent fee to the IRS, or that there is a problem with your documentation. These institutions never threaten or charge such amounts, especially over the phone. Identity theft. Someone gets your personal information, such as your social security number, and opens accounts in your name. This can even happen with improperly disposed trash. Card skimming or cloning. When you swipe your card on compromised machines, like at gas stations, and someone copies your data. How to truly protect yourself. Here are practical tips that anyone can apply in their daily lives. Never share personal information over the phone or email unless you are sure who is on the other side. Use strong passwords and enable two-step verification, 2FA, in all applications and banks. Check your bank and card statements frequently. See something strange, call the bank immediately. Use credit monitoring services. Some banks offer it for free, which notifies you if someone tries to use your name. Shred papers with confidential information before throwing them away. Avoid using public Wi-Fi to bank or shop online. Never click on suspicious links, even if they appear to come from someone you know. What if I am a victim? If you fall for a scam, don't feel ashamed. This can happen to anyone. But quickly, call your bank or credit card company immediately. They can block access and reverse transactions. Reporting to the FTC, Federal Trade Commission, in identitytheft.gov. Put a fraud alert on your credit by contacting one of the credit bureaus, Experian, TransUnion, or Equifax. File a police report. This can help you in the recovery process. You've built your credit with effort. Protecting this is part of your financial health. The more informed you are, the less vulnerable you will be. Checking account versus savings account in the US. The checking account is the one you use for your day-to-day expenses. It's where your salary is deposited, and it's where you pay your bills, use your debit card to make purchases, make transfers, and withdraw money from ATMs. This account is designed for constant movement, that is, money coming in and going out all the time. Some accounts may charge a monthly fee, but you can often avoid this charge if you make regular deposits, like your salary, or maintain a minimum balance. A savings account is for keeping money that you want to save and not use every day. It is a safe place to keep a reserve for emergencies, trips, or future projects. Savings accounts earn interest. That is, your money can grow a little over time, even if the yield is low. Therefore, it is not recommended for frequent spending, and some banks limit the number of withdrawals and transfers you can make per month. The best thing to do is to have both accounts. Use the checking account to pay for everything you need each month and for daily transactions, and use the savings account to save the money you want to protect and see grow. This way, you avoid mixing your daily money with your savings, helping to keep your financial planning organized and secure. How to choose the right bank for you in the United States. Once you understand the difference between a checking account and a savings account, it's important to know that not all banks are created equal, and choosing the right bank can make a big difference in your financial life here in the United States. Each bank has its own fees, perks, and services, so it's worth doing some research before opening an account. First, think about which services you will use the most. If you prefer to do everything on your phone, choose a bank with an easy and secure app. If you want to save on fees, look for banks that offer accounts with no monthly fees or with conditions for exemption, such as maintaining a minimum balance or having direct deposit of your salary. Another important point is to check where the branches and ATMs are located. It's good to have a bank that has locations close to home or work, to make it easier when you need in-person service or to withdraw money without paying extra fees. In addition to traditional banks, consider credit unions. Credit unions. They are non-profit financial institutions, and they usually offer better interest rates, fewer fees, and more personalized service. Also pay attention to costs. In addition to the monthly account fee, check whether there are fees for transfers, withdrawals from ATMs outside the network, issuing checks, and even for issuing a debit or credit card. Ultimately, the ideal bank is one that meets your everyday needs with ease, charges fair fees, and helps you keep your money safe and accessible. Opening your bank account in the United States. What you need to know. Now that you know how to choose the right bank, let's talk about the steps to open your bank account here in the United States. Generally, to open an account, you will need some basic documents, such as valid passport or identity document, proof of U.S. address. This can be a utility bill, rental agreement, or official correspondence. Social Security number, SSN, or taxpayer identification number, ITIN, if you have one. Sometimes a letter from your employer or proof of income may be requested. Many banks allow you to open an account online, but in some cases, especially for newcomers, you may need to visit a branch in person. If you don't have an SSN or ITIN yet, there are banks that accept alternative documents, but this varies greatly. Once you open your account, the bank will give you a debit card that you can use to make purchases, pay bills, and withdraw cash. It's important to activate the card as soon as it arrives and set a secure password. Also, take the opportunity to set up online banking access and download the app on your phone. This makes it much easier to control your finances and allows you to pay bills and transfer money without having to leave your home. Remember, always keep your details up to date with the bank and store your documents carefully to avoid future problems. Important precautions when using your U.S. bank account. Once your account is up and running, it's important to take a few precautions to avoid any headaches. First, always monitor your balance and statements to make sure there are no erroneous or suspicious charges. Many banks now send you notifications on your phone for every purchase or withdrawal, which helps you spot fraud quickly. Another point is to avoid having a negative balance, as banks charge high fees for this. Plan your expenses and, if possible, keep a reserve in the account for emergencies. Also, be careful with checks. They're still in use, but they can be an easy target for scams if you don't protect yours. If you use a credit card linked to your account, remember to pay your bill on time to avoid interest and maintain a good credit history. And be aware of bank fees. Some banks charge monthly fees, but you can usually avoid them by maintaining a minimum balance or making regular deposits. Always ask your bank what these conditions are. Finally, if you are traveling, notify your bank to avoid having your cards blocked due to suspected fraud. How to build a good credit history in the U.S. Having a good credit history is super important in the United States because it influences many things, from getting a loan to buy a house to getting a new cell phone or renting an apartment. To start building this history, the ideal is to have a credit card, even if it has a low limit, and use it responsibly. This means paying your bills on time and not spending more than you can afford. It's also a good idea to keep your credit limit usage at around 30% or less, because banks look at this to see if you're trustworthy. If you don't have a credit card, you can try to get a secured credit card, which is like a card guaranteed by a deposit you make. Little by little, if you use it correctly, your credit score will improve. Another tip is to avoid opening too many accounts or applying for too many loans at the same time, as this can be seen as a sign of risk. Remember that maintaining a clean and reliable history will open many doors for you in the future. Why it's important to plan and prepare for tough economic times. The economy isn't always growing. Sometimes it slows down, and even recessions can happen, like the one we're seeing now. This can affect jobs, prices, and even home values. Therefore, it is very important to have a plan for these times. This means saving money whenever possible, avoiding unnecessary debt, and seeking additional sources of income. It's also a good idea to learn about safe, diversified investments to protect your money when the economy is unstable. Remember that even if the scenario seems bad, these phases help to clean up the market and create new opportunities for those who are prepared. So, if you live in the US, take care of your money today to have peace of mind tomorrow.